Guy had 40,000, and that check was good.
Well, good morning. This is Rich Morrison, and welcome to the aftermath. We'll go ahead and kick off. It's 9:01. So thanks for joining. Those of you who've joined in, I think we've still got a few more people probably going to come in here as we get started. So as we kick off here on Wednesday morning, the big word of the month, I guess, is volatility. We've got a lot of it right now. We'll talk about markets here in a second, but I want to start with weather first. And I know that's starting to become an important deal for a lot of us as we look ahead to the growing season. We've had a lot of forecasts as far as what kind of a year we're going to have. The reason it's maybe a big deal is we've got some dry areas of the country as we get started, especially through the middle, as well as in the west, southwest, even out into the eastern belt, Ohio, Pennsylvania, still very dry. Never really got fixed from last fall. And so, what's going on here right at the moment? The big story, of course, is going to be this new storm system coming in over the weekend. Looks like the Northwest is going to get a blast of cold air and some snow down in the mid South, across the center part of the country into the southeast, expected to see some severe weather. And from what I see, that low pressure they said is going to be the biggest low or the strongest low since 2019. So, nice spring storm. Hopefully, everybody avoids danger and hopefully we'll make it through the weekend in good shape. Now, what's ahead for us as far as the forecast goes, as you look out towards the end of the month, the 6 to 10 day outlook calls, for much of the center of the country, warm and moist, but still dry to the south, cool to the west. Similar for the 8 to 14 day forecast. And kind of watching a couple of different areas. The southwest, that usually seems to be where droughts start, I guess, in the United States. And looks like we're going to stay fairly dry in Texas and New Mexico. And then the Ohio Valley, which a lot of people talking about being a wet spring. And so we'll kind of keep an eye on those. As you look out into the summer months, I did have these forecast maps in my market outlook a day or two ago. The European model, these are their 3 month forecasts, and really kind of talking about what I just mentioned. That the Southwest is where the dry weather is starting. The north, the Ohio Valley, I guess, on the wet side as you go into spring. As you get out into the summer months, it looks like most of the western half of the country below normal precipitation expected, and kind of creeping east as you go into June, July, August. So we'll see what happens. Of course, we have trouble forecasting weather this weekend, let alone what's going to happen through the summer. But generally speaking, that's been the talk for several months. That dry to the west, and still looks like that's the talk here as we get started into the growing season. So now volatility in the markets. Of course, all of the stuff with tariffs right now, kind of at the forefront, and moving a lot of the markets. And you see what the dollar index has done over the last 5 weeks. We've seen a pretty big dip after we made a new high in the dollar. Of course, uncertainty, the name of the game there. As you look at the S&P index, the S&P 500, we've fallen 500 points off the high. I show this view, and then if you look at the long term, the weekly view of the S&P, just looks like kind of a blip or a correction. So in the short term, we've seen a pretty good sell off. In the long term picture, still in an uptrending type market. The other big movement has been in the egg market. Did see that eggs have fallen for the first time in a while. So I know eggs had been climbing since last fall. Of course, the number of laying hens probably the biggest reason for that. We've reduced the size of the flock, and even that said, looks like we're starting to see a little bit of a response. So egg prices starting to come down. That seems to be the one that everybody wants to talk about. So what's going on in the markets? USDA has been a big driver for what's happened over the last 2 or 3 months. However, if you look at yesterday's report, it was just kind of the same old thing. Didn't see any changes to the numbers to speak of, except for in wheat. We'll look at the numbers here as we get into the crops. The tariff wars certainly at the forefront. Yesterday, this was a headline: the U.S. paused tariffs on some Canadian and Mexican imports until April 2nd. Yesterday morning, Ontario was said to be slapping a 25% increase on electricity into certain U.S. states. The U.S. came out in retaliation, and then Canada backed off very quickly on that surcharge. So I think this is going to be the name of the game here for the next several weeks, maybe even months. This morning, talking about the 25% tariff kicks in on steel and aluminum imports. Canada supposedly threatening tariffs back against U.S. crops. Uh, in some ways, I would consider that a little bit of an idle threat because Europe isn't buying much of our stuff anyway right now. So, and we'll talk about that with soybeans also. But, China can say that it's going to tariff corn, for example, but they're not buying any U.S. corn right now. So I guess you can put anything on paper you want, but if you're not buying anything, then maybe it doesn't matter. The managed funds, we'll look at the breakout by crop here in a few minutes, but it's been a huge liquidation over the last couple of weeks. You can see that, the biggest week of selling in 2 years last week. A lot of that was in corn, where the funds sold off a big chunk of their huge long position in corn. They had bought back a little bit since then. You can see here from peak trading showing that they had been net buyers since last Tuesday. So we continue to see some back and forth there. Finally, South America. We'll look at their numbers here as we get into beans, especially here in a few minutes. But let's start out with corn. When you look at the balance sheet on corn right now, again, USDA didn't change any of the numbers yesterday, still telling us that we're going to end the year with 1.54 billion bushels of corn. I think most people were expecting USDA to raise the export number yesterday. That did not happen. Most people expected ending stocks to come down, maybe down to 1.4 billion. Didn't happen. So I think USDA, maybe with everything going on with tariffs at the moment, maybe decided we'll just skip this month and take the month off and wait and see how things play out as far as business goes. But when you look at export commitments so far year to date, when you compare to last year, the tan line, we're running way above last year at this point. And if you look at USDA's target compared to last year, it's not as big of a spread. So either A, USDA thinks we're going to slow down the pace of sales through the rest of the crop or the marketing year, or B, they're wrong and need to raise this number. And so I think that's where, they just took the month off as far as changing the estimate. But if the sales numbers continue very strong, and we'll get the next report tomorrow morning, if we continue to see strong sales numbers, I think USDA is almost going to be forced to have to increase that number. And so I think the trade probably is even factoring some of that in right now. I think we probably are trading maybe a 1.4 carry out at this point because I don't think most people believe USDA's number. If you look at where we're selling corn, the interesting part about this is we're basically selling what we sold 3 years ago, but without China this year. 3 years ago we had the Chinese in the market. They kind of disappeared over the last couple of years, and if they're buying corn, they've been buying it out of South America. And right now, it's just all the normal buyers. It's Mexico, Japan, South Korea, Colombia. They've just been buying more than they normally would at this time of the year. And so, again, are they going to keep that pace up or will they eventually slow down? I think that's the big question mark. But if you need corn, you kind of have to come to the United States because if you look at the other big suppliers right now, of course, we know the situation in Ukraine, but Ukraine has been shipping corn to China. Brazil, we'll look at them here in a second, but their stocks are down. Argentina's down. So, and you look at the big three total, they're way down from where they were just a year ago. And the big story in Brazil right now is ethanol. Brazilian government is really pushing ethanol production. They are, however, tariffing U.S. ethanol coming into Brazil. So they're trying to protect that industry as they build it. We'll see what happens, but you can see their domestic usage of corn, how it's really grown over the last 2 to 3 years. So, so that's good news for U.S. farmers that, if Brazilian domestic demand continues to grow, that, we're not going to see as much competition. And if countries like China need corn, they would have to potentially come to the United States. So it looks to me somewhat friendly from that standpoint. And looking at the China situation, they're consumption domestically continues to grow. Their production continues to grow. They are incenting farmers to grow more corn over there, unless soybeans. They would like to import the beans out of Brazil. I think that makes sense for them. But you can see ending stocks, still hanging in at a fairly flat number. And you can see down at the bottom of this chart, pretty good chart showing imports as well. And this year, their imports have been down partly because they've had good production. So that's the bottom line. If they have a production issue, then probably have to come to the United States again. So here's what the funds have done. They had just a couple of weeks back had taken their long position in corn up to 360,000 contracts, basically matching where they were back in 2021 and 22. The only other 2 years they had held long positions this size were back in 2010 and 2011. And so I said a few weeks ago, I would have anticipated the funds probably holding on to their length until we got into spring, see what happens with plantings. But everything else that's happened here recently has really gotten them to kind of get a little scared and run for the exit doors. And so last week alone, they liquidated over 100,000 contracts of their long position, still long 220 as of last Tuesday night's close. It looks like here this morning we're seeing a little bit more selling again. So, but I've also said over the winter, to me, this is the biggest risk that we had in the corn market is if these people decide at some point it's time to get out, then there's really not a lot there to support it. And so that's what's happened. In some cases, you could say that might be healthy for the market. We'll see. If you chase some weak longs out, maybe we build a base and try to move the market back up at some point. And so you can see the impact of their selling. By the way, I know there's a lot of farm selling happened on the way up too. If you look at what, from January through beginning of February in this rally, I know there's a lot of farmer corn bought. I was talking to somebody here along the Illinois River yesterday. They said one of the terminals had estimated had 6 million bushels of corn to come in the month of March. So there's a lot of corn moving right now around the country, and I think that's the case. Just people took advantage of the rally, and good for everybody that did, because that's what you're supposed to do. And now we've kind of reset price, I guess. We did at least stop the downside here at the first of the month, just above 440 May corn. Rallied above the 9-day moving average the last couple of days. Here this morning, we're trading back below it once again. So that red line, the 9-day moving average, the sooner we can flatten that out, the better, and eventually try to turn that higher. I've drawn in some of the retracement lines on here. The 50% retracement from the recent low back to the February high is right about 480. And I think that's a realistic target for anybody that's looking to sell the next rally. We got within a few pennies of it yesterday and then set back down here this morning. That 480 number is also just a little bit below the 50-day and the 20-day moving average lines as well up here. So I think that, to me, if I've got corn remaining to be sold and want to sell the next rally, that's probably what I would look at. Looking ahead to new crop, these were the numbers from the Ag Outlook Forum a couple of weeks ago. USDA came out with 94 million acres of corn estimated this year. That seemed to catch a few people off guard. I'm not sure why, because I think a lot of us were thinking down that road. You can look down through the balance sheet. They're using a yield of 181, production a little less than 15.6 billion bushels. They're very aggressive, I think, on their demand numbers for next year. Feed, especially at 5.9 billion. Ethanol running strong at 5.5 billion. Exports still at 2.4. They think ending stocks at 1965, and they're predicting an average farm price down to $4.20. I've been using, I think likely that we could flip acres back to where we were back in 23, just reversing what we did last year. Maybe you go up to 94.6 million acres. My yield, I'm using a little bit lower than them with more acres, but I also am using a little bit lower feed number. I don't see that the livestock, the poultry numbers are there yet to feed 5.9 billion bushels of corn. So I'm thinking more in line with this year, maybe even a little bit less. I do think the export numbers still ought to be strong. because you just don't have these other countries producing a big crop that's exportable. So under that scenario, you're looking at stocks maybe pushing up over 2 billion. I threw another situation on here. I don't think this is likely, but if we were to go back and match 2012's record at 97.2 million acres, then you can see some numbers down below. So I do think this 94 to 95 range seems likely for the year. And so consequently, you're going to start out probably forecasting a lower farm price in the year ahead. So another reason for more acres, you look at the bean corn ratio right now running just above 2.2 to 1. So it's probably telling a lot of people to plant more corn. I'm hearing it across not just the I states, but in the northwestern part of the corn belt, southern part of the corn belt. So seems like we're going to pick up more corn just about everywhere. And so, it's been a nice rally through the month of February. We set our insurance price at 470. So that rally was very, very welcomed, considering where we were back in December. And so now the markets have tailed back off. We're sitting at about 450 on December corn here this morning. We'll talk about some marketing strategies here in a few minutes. Today, you got the RSI at 37, stochastics down in the 20s. Probably not the day you want to be marketing grain. Looks like the 100-day moving average right now providing some support here this morning. As far as targets go, I always like to try to sell better than the insurance price. That's one of my targets. And so 470, I think that, anytime you can improve on your insurance guarantee by selling a higher price, that makes a lot of sense to me. So probably be looking at some targets up that way. You look at the number of rallies too that we've had over the last, 9 months, 10 months. We've really had three, although this last one was really held for quite a while. So when's the next one going to be? Not quite sure. What's going to cause it? Not quite sure. Maybe it's spring weather. Who knows? But maybe it's Brazilian crop weather. They are pretty much done planting the second corn crop down there. There is some concern about heat, dry weather as you get into their growing season. So I do think the market's going to be focusing on that as well. And so a lot of it's going to depend on the funds as well. What do the funds decide to do? But I think I'd probably want some offers in this 470 to 480 window if the market's able to get back up to that level. And then lastly, if you look at the historical tendency of December corn, here we are moving into the middle of March, and you look at the 3, the 5, and the 10-year average, along with last year's December corn futures, this is really going to be our best window over the next 90 days to be marketing corn. So once you get past about the 15th or so of June, the markets tend to trend lower and stay down through the fall. So I do want to take advantage of the seasonals. If we get a little scare this spring, whether it's in the southern hemisphere or here, take advantage to go ahead and get some more corn on the books. Switching to soybeans, the big story in the oil seed market at the moment has been Canada and the fact that China imposed tariffs on Canada, in particular Canadian rapeseed. And so the rapeseed market's been getting hammered this week. And in turn, soybean oil has been down. In turn, that's had pressure on the soybean market. But when you look at, who is the rapeseed supplier to the world, Canada is the big one. Of course, if we're tariffing them, I'm not quite sure what's going on like in North Dakota right now. If you're running a crushing plant, you buy canola out of Canada. Not quite sure how that's all working at the moment. So that's a dynamic I haven't read anything on, but I'm kind of curious. But if you look at what's happened in the rapeseed market, futures market, it's been a pretty big dive. Now, again, you had a very overbought market just 2 weeks ago. And so this market was probably due for a bit of a correction on its own. However, the tariff situation between China and Canada has really kind of triggered some of the selling. And that's what left this gap here on Monday when the market opened. So we'll see if that can bounce back. It looks like it's moving into oversold territory pretty darn quick. But bean oil kind of following along with the canola market. So, and in turn, soybean futures as well. So they're all kind of tied together in some way, shape, or form. Now, yesterday's report, the government didn't change the bottom line kept ending stocks at 380 million bushels. They tweaked a couple of the numbers in the middle here with seed and residual usage. The one number they did change was the average farm price, dropped it to 9.95. That was down 15 cents. Now, one thing to remember about this price, the only place it gets used is for PLC and ARC payments at the end of the marketing year. And the end of the marketing year is August 31. So we're halfway through the marketing year now, but that'll be the number. If you signed up for the ARC program last year, you'll take that times your county's final yield to determine the county revenue. We'll compare it to the trigger. If you signed up for PLC, we're not close to the PLC trigger at this time. So, but that's where that price will end up eventually getting used. Now, the positive on soybeans continues to be the domestic crush. We've got these new plants that have come online. We've got more capacity coming online in 25 and into 26, 27. And so our records continue to be made each month. The January, I don't have it on here, but it was a record again, even though it was down from December, still a big number. So that's the positive. When you look at the balance sheet at 2410 on the crush, that's a record number. We're going to continue to set records. The concern is on the export side of things. And even though exports are up from last year, we're still running below the 5-year average. USDA's target is down for the year. Right now we're moving into the window where the demand really shifts to the southern hemisphere. So we don't expect to see export sales pick up at all. We'll get another report tomorrow morning, likely show, that numbers continue to slide a little bit as we move into the spring and summer. So the big three, no changes from USDA yesterday. Still have Argentina at 49 million tons, Brazil at 169. CONAB, the Brazilian government, will put out their crop report tomorrow. They were at 166 last month. Several private analysts have been around 170 or 171. So be kind of curious to see if CONAB raises their number or if everybody else kind of comes back to them a little bit. But the USDA is right in the middle of where most of those estimates are. Still, we're looking at the third straight record crop between the three big countries in the world. And we're looking at world carryout being a record high as well this year. And so it's, again, I've said this for several months. It's just really hard to paint a bullish picture for soybeans at the present time, given the stock situation, given that world demand isn't growing, even though domestic demand is growing here in the United States. China's demand isn't growing. The pig numbers are not growing. Feed numbers are not growing in China. So it's really kind of hard to, without that big user using more beans, it's really kind of hard to get excited in the big long-term picture. And so, here's what the funds have done, and I think they kind of agree. They did have a couple of big buying runs this year. Number one was back in the fall when the palm oil market rallied due to lower production in Malaysia. That spilled over into U.S. bean oil, which got the bean market, got the funds to buy back their shorts and beans. And then the second big run was dry weather in Argentina and the January crop report. And so the funds went long, probably looked at each other and said, what are we doing? Long beans. We're ahead of South America, ahead of the Brazilian harvest, which looks like it's going to be a record. And so these people have gone back to the short side of the bean market again. And you couple that with the canola situation right now, concern about tariffs and concern about world usage in general, and they're trading on the short side. I would expect if I were a fund trader, I'd rather be short beans. And I think there's probably a lot of spreading been going on as well. Short beans, long corn. So that's been a pretty common trade. And really, if you look at the value of U.S. beans, the problem we have with beans is that our beans are too expensive. And latest, values delivered to China, we got U.S. beans up here versus Argentine, Brazilian beans. I think it's going to be well out into the fall before the United States becomes competitive, probably into October, maybe even November, based on the size of that Brazilian crop and how long it's going to take them to ship. So I would expect to not have the export market on our side here for several months. So, what do you do if you still had any old beans? I've been saying this a couple of months. I'd have got rid of them by the end of January, but at this point, I think $10 is still not a bad level. ideally you'd see a bounce. You got the RSI at 36, stochastics in the 20s. Probably tells us I'd look for a bounce, maybe back up to the 100, the 20, 50-day moving averages. These are all in the 1028 to 1043 range. That might be a good opportunity then to price any remaining old crop soybeans. Long term, you look at the blue line, the 200-day moving average. We did probe above it in February, but that has still been tough resistance for this market. And we really hadn't sustained any time above that since clear back in late 2023. And so as long as that 200-day moving average is trending lower, I tend to think that that's really what's dictating the bean market. Now, looking at U.S. numbers for new crop, not bearish. 84 million acres is what the Ag Outlook Forum used. I think, again, we could flip back to a year ago. Maybe you plant less beans than that. 83.6 is what I'm using, with a decent yield. I think demand should stay somewhat firm, especially the crush, although I'm not as optimistic as USDA is on export demand based on the size of the South American crop. But you're still looking at stocks probably likely somewhere in the low to mid 300s, even with a good yield this year. So the government says $10 beans. I would probably lean a little bit below that level, probably somewhere in the nines. But it's really going to boil down to what happens in South America. How many acres does Brazil plant this fall? Do they increase another 2 to 3% like they've been doing? What happens with China demand? Do we see any kind of a bump there, or does it just stay flat? And if you have flat Chinese demand with more Brazilian acres, it's really going to offset what happens here in the United States. So it's Brazil's going to be, it becomes more and more important to the market every year. I think this year in particular, it's probably going to be the bit, even more so. So what do we plant down there this fall? I think that's going to be the big story. So November beans still trade above $10. Again, the indicators would tell me now's not a good time to be a hedger. We set our insurance price at 1054, so we can still utilize that through next Monday, the last day to make any changes or additions to crop insurance. So for revenue protection, SCO, ECO, 1054. So, we still get to use that price. And from a marketing perspective, I would like to be able to improve on that. Looks like the 200-day moving average at 1054 now. So maybe 1050 is a good place to have some offers in case this market bounces back up. And again, you see that we've only had really 3 rallies to speak of, significant rallies in the last 10 months. So, and if you look at the timing of the bean market, here we are moving into the middle of March, and from now through the 1st of June is usually our best time to market soybeans as well. So want to be selling rallies as we get them. And again, I think the reason for selling rallies and the reason to utilize maybe higher levels of insurance this year isn't so much the U.S. situation, it's the world situation. World carryout being big, Brazilian acres likely to be big again this fall. Wheat, the wheat story really has been focused more this year on world numbers. And if you look at the world exporters of wheat, we're trading down, or we're down quite a bit. So that has given at least some support to the wheat market. The big one has been Russia. The Russian wheat crop was down this year. Russian exports are down. That's the good news. The bad news is you look at these recent 3 years compared to all the others, they're still going to export a lot of wheat, just not as much as they did a year ago. The U.S. balance sheet numbers, USDA raised stocks yesterday. That was the only crop that really saw a significant change. They raised imports 10 million bushels, lowered exports 15 million bushels. So ending stocks went back up 25 to 819 million bushels. Average farm price dropped a nickel to 550. And you carry that over into new crop. Basically, they think the balance sheet next year is going to be almost identical, and that ending stocks will still be over 800 million bushels. So barring any weather issue here in the United States, you would lean towards probably being a little bit bearish in the wheat. And that's what the funds have done. Funds are still short Chicago wheat. Did buy quite a bit of it back here January, February, when we had the rally in corn. That did lift the wheat market for a short period. And now that they've sold corn, they've gone back to selling wheat again. So more than likely, the wheat market probably will continue to follow the corn market. I don't see any reason, unless weather becomes an issue here in the U.S., why wheat would do its own thing at this point. And so we did trade wheat down to a new contract low just a week ago after we had rallied wheat, and we had some great opportunities to market. And I mentioned the base price on insurance. That was at 5.94, so we had some opportunities to sell $6 plus wheat. Hope we took advantage. I think targets. The 200-day moving average was a great target. We blew through it for a few days, and now we're back under it again. So you've from a resistance standpoint, the 50 and the 100-day moving average just above 580 looks to be a first upside target. Then I think your 200-day moving average just under 605 would be another target of mine. So if you've got wheat in the field and it's looking decent, those might be a couple places to have some offers in. Similar with Kansas City wheat, went down to make a new low, not a contract low, but a new seasonal low here last week. Markets have rallied. Indicators are oversold, but how much upside do you have? I would look at $6 again. The 20 and the 200-day moving average lines up here just above $6. I think that's a good target to be locking in some price. Minneapolis September wheat, we set the insurance price at $6.55 for spring wheat. And kind of like corn and beans, I think that's going to be an attractive thing to look at using, whether it's with your revenue protection policy or whether it's stepping out with ECO this year at 95% of that level, get you pretty good protection there as well. And then maybe you get back up close to 650, the blue line, be a good opportunity to be a hedger for this coming year. And then if you look at the seasonal trends in wheat, kind of similar to corn and beans, May, June tends to be the high months. But really, from now through June, is your best window. So if we get rallies over the next 90 days in wheat, probably a good opportunity to be locking some of that in. And finally, in cotton, USDA did not make any changes to the balance sheet. First time they didn't give us any bearish changes yesterday. The only change they did make was the average farm price fell a half cent to 63 cents. So that continues to really signal to me the importance of PLC for cotton right now. Unlike the other crops, the PLC program puts a price floor under cottonseed. We'll talk about that here in a few minutes. But yesterday's dip in the average farm price kind of reiterated why that's a big deal. Now, cotton may be getting a little bit of a positive, some positive news. We did see this story on Reuters yesterday that India cotton imports are expected to double this year due to a drop in production. So it didn't really seem to spill into the market much, but at least it did get noticed. And so why is it a big deal? Well, the funds right now are record short cotton. And so any news like that could possibly trigger them to buy back some of that short position. And so unlike corn, just the opposite of corn, I think the biggest risk that corn had was that the funds were holding a huge long position. Right now, the biggest possible positive thing for cotton is the funds are short. And so anything that would cause them to want to buy it back certainly could give us some support. But boy, you look at this chart, it's just a downhill. It looks like a ski slope, I guess. And I've drawn this gray line, kind of connecting all the tops, and it's really following these moving averages, especially the 50-day moving average right now. But we did make a new contract low last week, and now we're about 4 cents off that low and trading back up to the 20-day moving average. So unlike the other crops, the RSI is trending higher, stochastics trending higher. So maybe that demand news coming out of India giving a little bit of positive spin that we just haven't had in forever. We've really only had one time where the RSI came close to touching 70 in the last 10 months. And so this market's just in dire need of positive news. Old crop, probably look at 70, 72 cents, the 100 and the 200-day moving average as some upside targets. Looking ahead to this coming year, USDA's ag outlook for them, they were using 10 million acres. The National Cotton Council came in at 9.56 million acres this year. I think everybody's in agreement we're going to probably give up some cotton acres, probably in the Delta, Mid-South area. I'm not hearing from anybody in Texas that they plan on planting anything other than cotton. Going through their balance sheets, you could take cotton stocks down either a little or a lot, depending on, what happens with final planted acres. And of course, what happens with demand. Both are expecting export demand at 13 million bales, which I think is pretty aggressive given where we've been the last 3 years. So we'll see. But I think the odds of still being above 4 million bale cotton stocks next year, to me, looks pretty good. So average farm price, the government says 65 cents. That again might be a little bit aggressive, but and that's a cash price. Here we are rallying December cotton off the low. We're 3.4 cents off the low here this morning, challenging this trend line. We'll see if we can trade above it. And if so, maybe gives us a little bit of an opportunity to trade up to the 100 or the 200-day moving average. We're now back above the insurance, or right back to the insurance price. I think it was at 69 cents. So if you get up to 70, 71 cents, might be an opportunity to start doing a little bit of hedging. And RSI at 55, stochastics kind of moving up into the 70s on the short-term line. So I think, again, take advantage of the rallies when we get them. And if you look at the seasonals, really cotton, this is the time of the year. April is the peak month that we typically tend to see. So, over the next 60, 90 days, take advantage of the rallies as we get them. So as we strategize for this coming year, our goal this time of the year is to try to put marketing together with insurance government programs, put a program together that's going to implement all three. When we look at, we've talked a lot about markets. When we look at the insurance side of it over the next, 4 or 5 days, we're primarily going to be looking at revenue protection, SCO and ECO. And then your deadline at the FSA office is actually extended this year until April 15, and that's to sign up for PLC and ARC program. I think most of us are probably going to make that decision quicker and therefore not have to wait until April to make it. But in case you've forgotten about these programs, RP is revenue protection on your farm. SCO is county coverage that starts at your farm levels coverage, goes up to 86%. And then ECO starts at 86 and goes to 90 or 95. ECO is the blue light special for this year because the one change the government made to the crop insurance program was increasing the copay from 44 to 65% on ECO this year. So we're going to see a lot more participation in the ECO program, partly because of that added copay from the government, also partly because of where the base prices were set. And the fact that we had that rally through February, and now that the prices are set well above where the market's trading at, it's really going to make ECO look like a better deal. At the FSA office, the PLC program is price protection only. I think I saw Farm Doc put a study out this morning on corn. If you thought corn price next year could be below 360, then PLC is probably the way to go. If you don't, then County ARC program is probably going to be the best bet. County ARC is an 86% revenue plan. It's a 10% band of dollars, but if you sign up for the County ARC, then that eliminates signing up for SCO at crop insurance program. You can do ECO no matter what you do at FSA because ECO is over and above the ARC County program. And so as we look at prices for this coming year, here on the right, the PLC prices are going to be the ones in the blue. These are going to come up this year because of an escalator clause in the program that when the ARC County price goes up, the PLC price is going to come up with it. And the ARC price are going to be the ones in red. And so you can see 503 corn, 1217 beans, 672 wheat, some of these other markets well above the PLC price. So ARC is a revenue program that takes this price times your county's 5-year Olympic average yield times 86%. So you can either have a revenue program using 503, or you can sign up for PLC, which then would enable you to buy SCO using the numbers in green. But I think for most of us, we would view SCO 86% using 470 versus 86% using 503. We would probably rather use the ARC price. Plus, ARC is free. The only hole in the ARC program, a couple of things that are different. ARC uses a market year average price that goes through the entire marketing year. That price won't actually be starting to set for this coming year until September 1st. And it goes all the way through August 31 of next year. So versus crop insurance using the spring and a fall price. But the hole in ARC is if you were to have a bad crop year and say the county yield ends up being down 20 bushels, but the price goes up $1.50, then the drop in the yield could be offset by the increase in the price. And ARC may not pay in that instance, whereas crop insurance would adjust because of the harvest price option. That said, 9.5 out of 10 years, ARC's probably going to be the better program on corn, beans, and wheat, given the higher price. And so I would still favor utilizing that program and then taking the premium I would save maybe on SCO and using it maybe on the ECO program up at the top. Now, for crops like rice, cotton, peanuts, PLC still looks like the better program. Even though you look at cotton, yeah, the ARC program price is a little bit higher. But if you look at where the market's at today for this year, you've got the PLC or the market year average on the current year at 34, 33. That number is actually going to come down a little bit compared to the PLC price. Cotton's in the market right now for a PLC payment. So I would have a hard time not taking the bird in the hand. And if USDA is continuing to talk lower prices this year, I think the PLC program makes sense on cotton as well as it does on rice and peanuts for this year. So how do you build your program this year? We've talked about ARC here in the middle. I still think the ARC program makes sense for corn, beans, and wheat. I think for a program like cotton, maybe I sign up for PLC, which then enables me to buy SCO instead of stacks. So maybe that's something I would look at there. Then how do I cover myself at the bottom? And then do I consider the ECO this year? Well, ECO, if you're not familiar with it, I would encourage you to go out. We've got these worksheets that we've made. We can walk you through the math and how ECO works. But ECO is a band of dollars. It's a 9% band across the top, starting at 95%. That band, the value of that band is determined using your APH. So farmers with higher APHs will take your APH times the insurance price, which on corn was 470, to determine the value of that 9% band of dollars. If the harvest price goes above 470, then we'll use it instead. And so in an event of a drought where the market rallies, then the dollars of protection will go up. So I did an example here of, I said the yield didn't change, but the price went down to last year's level at 416. And so if the yield stayed the same, then we would end up having a loss because of the drop in price. We would end up collecting basically 72% of that 9% band, or about $61 an acre. So if you go to last year's fall price on insurance, we'd be looking at a pretty substantial payment if the yield didn't change. So we'd also have the matrix included with this, and you can look at 200 plus examples. But if we assume going into the year that the yield is going to be the same at 100%, then at 446 December corn, we're starting to trigger some money back. And this past week, we've traded below 446. So I considered ECO in the money. And the fact that we started at 470 on corn, 1054 on beans, spring wheat at 655. I think all three of those crops, it does make sense given the uncertainty with tariffs, acres. I think that this is going to be a decent program to at least take a look at, especially with the added government copay here this year. Corn's going to be about $10 cheaper than a year ago. Beans are going to be about $6 cheaper. Wheat's going to be about $6 cheaper. So I think it's going to make sense to take a look at. One other thing I would mention here with ECO, if we have a drought, the matrix shows what happens then when the price goes up in the fall, that you get to utilize that higher price. Therefore, the dollars of coverage go up as well. In our market report email letter, you go back a couple of weeks ago, this was a page I had in there for 2 or 3 days, looking at some different marketing alternatives rather than just selling corn at that time. If you were nervous about selling too much, we were looking at utilizing minimum price, put options, long put, short call, min-max type strategy. The three-way option trade was pretty intriguing as well. But I was looking at utilizing ECO basically as a put option. And at that time, you had a 471 average. 95% of that would be 447, considered to be a strike price if we assume an unchanged county yield. So we've talked about this for a few weeks. This has been in my letter the last couple of days. Some other talk about ECO, using it again as a put option for this coming year. You can go out and look at the video that we've got on YouTube. But one thing I'd brought up the last few days was if you consider that ECO is a put option and it has a built-in put option, that I was looking at possibly going to the market, and keep in mind that the put option in ECO is subsidized at 65%. I was looking at going to the market and selling 390 puts basically to pay for the ECO policy. Now, your risk if you did that is that if corn trades below 390 at some point, or especially at expiration, then you would be long 390 corn. I think at this point, most of us don't see a risk in that, a big risk in it. But if you happen to be long corn at 390, then you're also got your revenue protection policy, your RP policy, that's probably going to be triggering a payment if we get that low. You've got the county ARC program that's probably going to be triggering a payment if we get that low. So you've got other sources to offset that money. So unless you're really scared to death that corn's going below 390, then maybe something like this might be something worth considering. So for those of you that are very astute with options, just trying to think outside the box on how you can manage your policy and the coverage you've got, especially the price part of the coverage. Also want to mention the producer profitability matrix we've got, which then you can kind of lump all of these things together. If you put your revenue protection policy in here with your expenses, with marketing, it's going to show you then your combinations of making and losing money. If I add the ECO coverage, put in the premium for it, if I add a forward sale, then this year, you can generate a lot of green on this screen. And with where price started with insurance, that was probably the big thing, because when we started doing these back in December when corn was 440, it was kind of hard to generate any chart without a lot of pink on it. But now that we've got the insurance price set at 470, if we're able to rally again, which I think is likely to happen at some point, and I can get a big chunk of grain sold, I think I can build a pretty decent program for this year. So I would encourage you to visit with your agent if you're curious to see this and you want to put your cost numbers in, put your plan in, see what it would look like for you. So this is the time of the year to, really put it all together, utilize the government program at FSA, utilize the insurance program, put your marketing plan together, and hopefully build a plan for this year. So what do we got coming up? Our sales closing deadline for insurance is extended until Monday due to the 15th being on Saturday. So we've got a couple of days or so left. 2 weeks from Monday, we got a pretty big report day. We'll get the planning intentions report, and we'll get a March 1 grain stocks report from USDA. That tends to be a mover a lot of years. So we'll be kind of curious to see what they have. April 10th will be our next WASDE report. I wouldn't expect much change in any of the numbers in that report. The FSA sign up is April 15th, which I think most of you will probably be done well before then. Good Friday, the markets will be closed on April 18th. We'll have our reports and stuff in May, and then Memorial Day markets will be closed once again. So that March 31 report, I'd circle my calendar for that one. That'll be a big one and likely to be very important to give us our first set of acreage numbers to start the year with. So just a quick reminder, if you're not signed up, we do our opening bell phone call, email letter in the afternoon. This aftermath webinar, we've got our thinking cap videos out on YouTube. If you go out to YouTube, type in NAU country, you can watch any of these you want, anytime you want. And we try to keep those up to date. We'll have this aftermath webinar out there as well here later today if you want to go watch that again. So thanks for joining today. Appreciate everybody tuning in. Hope you have a safe month ahead. I know a lot of people want to get in the field here soon. We'll be finishing up the insurance signups here over the next couple of days, and we'll talk to you again real soon. Thanks a lot, and take care.